Okay, good afternoon, everyone. Thank you very much for joining us today in our latest scheme sessions volume. My name is Joanne Tibbett. I'm a partner in the pensions team at Gowling WLG, and I'll be chairing the session today. Before we get into the session, there's just a few housekeeping bits and pieces I'd like to mention, please. So today's session is being recorded, so if you want to watch it again, or if any of your colleagues haven't been able to make it, it will be available and uploaded to our website. If you've got any questions, which our speakers would be very happy to answer, please use the Q&A function and we'll address questions at the end of the presentations. We'll aim to answer as many as we can in the time that we've got, and if we're not able to answer all of them, obviously we will come back to you separately on those. We've got an hour in the diary, quite a lot to cover. We're proposing to probably finish just before 1 o'clock, but we'll see how we go on the Q&As just to get through as many of those. So today we're exploring current developments in the pensions risk transfer market, how trustees and insurers can work together, and looking at managing some issues that both Sarah and Rhiannon have seen come up on transactions recently. So our speakers today are Sarah Chambers. Sarah is a legal director in our pensions team here at Gowling. She advises trustees and insurers on a very wide range of transactions, from the very small to multi-billion-pound transactions. And we're also really pleased to be joined by Rhiannon Littlewood. Rhiannon's a Senior Business Development Manager at Standard Life, where she's been for 3 years. And prior to that, she was a consulting actuary at Aon. So without further ado, I'm going to hand over to Sarah, who's going to deal with some legal aspects on pensions risk transfer. Thanks, Sarah.
Thanks, Jo. So I'm going to start off talking through the legal aspects, if I can make the slides move. And indeed I can. So the agenda is that we're going to talk a bit about transferring risk. What are the options? So a bit of a kind of starter to the topic as a whole. Then we're going to talk about where is the market now, what we're seeing, how we've got to where we are. Talking about current developments and innovations, there is lots going on at the moment, and the whole risk transfer market has changed quite a lot in recent years. We'll be talking about what we're seeing both on the smaller trades and the bigger trades. And then I'm going to cover some kind of other tricky issues for trustees that don't necessarily relate directly to the BPA, although they may do, but are kind of things around the edges which trustees need to think about if they're looking at going down the risk transfer route. So, transferring risk, what are we talking about? Risk transfer is actually a really broad topic. So a lot of the time when I'm talking about it, I'm talking about it in the context of bulk purchase annuity contracts, both as kind of long-term investments. So that was a lot more common, pensioner-only buy-ins and that kind of thing, or actually full scheme buy-in to buy-out projects. It's actually broader than that. So longevity swaps, asset-backed funding, super funds I hadn't put on the list, but should be there. And ultimately, they're kind of not the greatest route to risk transfer, but transfer into the PPF, or if things are a bit better on the funding side when there's insolvencies, kind of PPF transactions, which tend to be with bulk purchase annuity insurers. So whilst that's the kind of breadth of what is pensions risk transfer, today, myself and Rhiannon are going to be talking about bulk purchase annuities, the options that are available, and the kind of challenges that we're seeing, particularly as more schemes are coming to market and with improved funding and whatnot. So there's no single type of bulk purchase annuity. So when we're talking about it, we might be talking about a full scheme, single transaction, full scheme buyout, but we might also be talking about other structures. And there are many more of these other structures coming into play at the moment because of the market and how things have changed and the funding levels of schemes. So bigger schemes might be looking at kind of umbrella structures where they set up kind of one structure that frames the contractual terms, but then there might be multiple transactions. So some trustees might want to do tranches of trades under a single umbrella, depending on funding and asset availability and whatnot. You might also have big schemes who where schemes are trading with a panel of insurers rather than a single insurer. But we might also, and they're not as common these days, but be talking about pensioner buy-ins, which were quite common a few years ago. We might also think about trades in the sense of what's being bought. So quite a lot of trades are on what we call a vanilla basis, where it's simply a matter of trustees insuring a specified set of benefits and a specified set of data, and that is what the bulk purchase annuity insurer is responsible for. But ultimately, that leaves the possibility of residual risks. So for bigger schemes or schemes that have particular concerns about where the residual risks might be, we have residual risk trades, and that would be residual risk covered by under a bulk purchase annuity contract covered by that insurer. And so we will also talk about that, and in fact how it's covering some but not all residual risks. In the old days, people would talk about all risks trades. They may have existed many a year ago, but now actually it's a matter of looking at whether some residual risk can be covered, and kind of what the insurer appetite is to exclusions and whatnot. So that's the kind of chat and the terminology we'll be using through this webinar. So in terms of kind of the meat of it, where are we now? What's going on with the market? The market has grown exponentially. It was growing over the last, say, 4 or 5 years anyway, as schemes have funded towards that. But now there is unprecedented levels of activity. So it was already going for it. And then Liz Truss did her thing for the industry. And actually the mini budget and the interest rate changes have really changed the position. So quite a lot of schemes that thought they may be 4 or 5 years away suddenly found themselves kind of looking and realizing they had surplus, or they were within touching distance of being able to buy out. So that's moved us from what was a busy market to an exceptionally busy market. And I think it's changed the landscape in terms of we've moved from a kind of trustees having a certain amount of power to more a movement of who the insurers want to trade with in a lot of instances, because there are significant capacity restraints across the industry, both for insurers in their pricing teams and their business development teams, as well as their transitions teams, bringing those schemes on and getting everything sorted out for buyout, but also within the advisory market, lawyers, brokers, everyone is busy doing these trades. So it's quite different, and we've got a lot going on. In terms of how it's impacted schemes, I think we've seen a huge amount of greater options and flexibilities, particularly for the larger transactions. But I think the knock on to the busyness is that there's potentially less flexibility for the smaller trades, and what constitutes small has changed significantly, and indeed what constitutes large has. So that's the kind of scene setting of what we're seeing, and then I'll talk, and then Rhiannon will talk about, you know, what that means in practice. So what's new? I think big trades, there had been a couple in 2019, 2020, where it's kind of low billions. We've now seen a scheme trade around the 6 billion mark at the beginning of the year, but there is talk and there is work being done on what we call mega schemes. So we're not talking single figure billions, we're talking double figure billions, and the needs of those schemes are different. The insurers naturally want to trade and want to do these big trades, but we are seeing challenges come with these, legal challenges and insurer challenges, that wouldn't have been the case with smaller schemes. So a lot of these mega schemes might have huge numbers of different benefit sections that have come from different mergers in over the years. They tend to be quite complex from a benefit perspective and quite old, a lot of them. these schemes might suddenly have the funding, but big schemes invest in different assets to small schemes. So there are lots of illiquid assets that come into play. There might have been previous transactions. So you might have insurance already in place with other insurers, but a scheme might then want to trade with different insurers. We might have already vanilla policies in place, so just the basic data plus benefits type fixed policies in place. But a scheme might say, well, if we're heading for buyout now, then we don't perceive these as investments, can we go down the residual risks route? So it's a very different beast to the small schemes. And small schemes we used to talk about 50 million as a small scheme, perhaps, but I think what constitutes a small scheme is moving a lot. And now we might describe anything under, say, 200 million as a small scheme. And the increasing challenge here relates into the capacity, because insurers are very busy. They're very busy on big schemes, mega schemes. And so they perhaps don't have the same amount of time or capacity to spend on the smaller schemes. But what we are seeing is the insurers know this is a challenge and know it's important that schemes are given the opportunity. So we're seeing some of the bigger insurers kind of effectively putting placeholders in so that they can trade with these smaller schemes. We're also seeing brokers try and find solutions. So variety of solutions from kind of platforms from which insurers can come and kind of pick schemes that may be ready, to small schemes, kind of streamlined approaches. So we are seeing innovation in this area, but it is a challenge. And we've gone from a position where a scheme would expect to get a number of insurers interested in trading with them to the smaller schemes in the market now desperately wanting to make themselves attractive for the insurers. So who's in the beauty parade has perhaps switched round. So that's what we're seeing in terms of size, and that is really different even to how it was 1 year, 2 years ago. So that has been quite a significant change to the mix. But as I mentioned, with size comes complexity. It's not always the big schemes, but it mainly is these days. So illiquid assets has become an absolute buzzword in pensions risk transfer in the last couple of years, because now we've got schemes who want to trade, but they have illiquid assets that they might have expected to have been able to manage before the point at which they got to buyout. There are a number of solutions, and the insurers have been amazingly flexible on trying to find these solutions to get these trades to happen. So I'm going to leave a lot of that chat to Rianne to talk about from her kind of insurer perspective. One thing where there's probably quite a lot of insurer but legal input is residual risk. So as I say, people used to call it all risks, never really was, but certainly isn't now. So residual risks is trying to get cover for things that go beyond, here is my benefit spec, here is my data. You know, please ensure that residual risks is trying to give the trustees or indeed the members a protection and a better experience should that turn out not to be the correct data or the correct legal interpretation. Residual risk comes in kind of many forms in some senses. So we think about it from a kind of, is there legal risk, is there data risk, but we're also talking about, are there overlooked or missing beneficiaries that need to be thought about? Is the GMP equalization methodology that's been used, you know, correct? So it's broader than just, you know, have we written down the right length of service for Mr. Smith, or is this the correct interpretation of revaluation on this particular scheme? But if insurers are taking this risk, and on big schemes this risk can be very significant, insurers want to make sure they know what they're taking, because ultimately they might agree to take residual risk, but they don't want to take known risk. So in order to determine that, there is a lot of due diligence. And I think due diligence now is being done in a much more kind of thorough and professional way to perhaps how it was done 5 or 10 years ago, because the importance of those risks is well known. This isn't just a problem for the insurers, the trustees, and the reason residual risks is so big and important is that it's quite a big process to go through, both for trustees and insurers. So trustees need to be able to give the insurers all of the information they need to determine what the risks are, and indeed whether benefits are currently correctly described, etc., etc. So this isn't just a matter of handing over a deed and rules and saying their insurer, that's the benefits. This is a big process. It's talking about trustee minutes, booklets, letters, all of the documents that might relate to the scheme and decisions made in terms of factors for early retirement, all kinds of things, a thorough process. Now, it kind of splits between the type of schemes, because certainly a year ago we'd have said best practice is to make a perfect data room, give this to insurers, and historically it was the insurers who arranged the due diligence with their lawyers and their internal pricing people. But actually things have changed over the last couple of years, and we're seeing a mix of schemes that are really well prepared and more the not smaller but mid-sized schemes who might be looking at residual risk, preparing well, doing significant levels of kind of vendor due diligence to help insurers, and we've been involved in projects like that. But there's also, you know, at the counter to that is the commercial reality sometimes is that some of the very big schemes just want to trade. So we've got this mix of schemes going, trying to be perfect and trying to put all the issues on the table to the insurers, and then we've got other schemes that are just dumping what data and information they have in a data room and saying, dear insurer, you go and have a look. So it's quite an interesting market in that sense, because there is actually no perfect answer. From an insurer's point of view, the perfect answer is for everything to be neat and tidy and go to the insurers with a perfect set of documents and things. But the commercial reality with some of the bigger schemes is that we're seeing some different approaches. So that's the kind of planning stage, and that depends on funding and the corporate push to buy out and all sorts of things, but not a consistent approach across the market. So preparation is very interesting in terms of residual risks, but also some of the legal structuring is really interesting. So as I mentioned, some of these big schemes already have buy-in policies in place that were there as kind of long-term investments, or even perhaps they've decided to have a series of trades with different insurers to spread the risk. But when it comes to kind of this approach to buyout, if a decision is made that residual risk should have some coverage, then what we're finding is a mix of approaches. So it might be that trustees are approaching insurer by insurer and trying to get those insurers to put residual risk on top of those existing policies. But we're also seeing wraparound where the final, or usually the final insurer, will not only insure on a vanilla basis the segment of benefits that they've agreed to insure, but also insure any risk across policies that across benefits where there are already policies in place for what are the known benefits. Structurally, that's quite difficult, but a lot of the big insurers have already been liaising, and there's been a few trades now such that there is, I wouldn't say standard form, but there is documents in place that set out the basis of any collaboration between the insurers. So it's becoming more normal, and there is precedent for how this can be done. So that's quite interesting, and it is allowing bigger schemes who've got existing policies in place to look at residual risk. Horizon scanning. So what's going to happen next? I'm not going to spend a long time on this, but just chuck out, there's a couple of things. In terms of making buyout quicker, it can be quite slow to go through a cleansing process, to check all the data, write out to everybody, correct any issues where the benefits haven't been done correctly. So there is a move, and some trustees are very keen that they want to get the scheme off their books really quickly. And so we are seeing trades where it will be a single premium trade. So one slug of cash, all the due diligence and the analysis of what needs to be corrected has been done up front, and the insurers have priced it. And then to the extent possible, and it tends to be the upwards actions rather than where there might be reductions, the insurers will take over, and the scheme will be bought out before necessarily all of the work has been done to correct benefits. So that's quite novel and quite interesting, and we're seeing it. The other thing where there's a lot of chat about it, and Rianne might comment later, is collateralized trades. I think they were more common a few years ago, then they haven't been. But with some of these mega trades, there's been quite a lot of chatter in the market that there might be a move towards collateralized trades where the insurers have to kind of ring fence assets, which match and which are acceptable to the trustees, and match the benefits that are being secured should anything go wrong. So that's a kind of one to watch in terms of market changes. And then I'm going to just shoot through other tricky issues for trustees. A word that we never thought we'd talk about a few years ago, surplus. Surplus is now a big discussion piece. What do we do when we've bought the benefits on either a vanilla or a residual risk basis and we've still got money left? So we're seeing a lot of discussion about what to do with it, what the rules actually allow, because some rules do not allow a return to an employer, and there would be a fetter on that. But there's always chatter, return to employer. Obviously a tax issue there as well, whether discretionary increases might be available under the rules or other discretionary benefits, augmentations to member benefits. I've put extra cover there, so trustees obviously might be looking at runoff, or ones who've insured on a vanilla basis might be going, oh, actually we can afford residual risk, can we get that out of an insurer? There are other potential residual risk options within the market. So how to spend the surplus, that's something that trustees need to think about, speak with the employer about. It might be there are solutions that don't go to kind of giving people more, but might look at merging schemes together, or if there's a DC section, using those funds to run on for DC contributions. So we're seeing a lot of all of those issues come out, and it depends on the scheme rules as to what works, and indeed, you know, what an employer is doing in terms of its general pension provision. Other things that are coming up, DC underpins and member options. You can't insure DC underpins. It gets a bit tricky. So we've seen different solutions out there, but it's something that needs to be tidied up. So if a trustee has a scheme with a DC underpin, it's not something that can be ignored till the last minute. It will need to be sorted out. There are ways to do it, but it takes a lot of actuarial input, lawyers, and it's a structuring piece. The same goes for member options. You get schemes that have huge amounts of options, but in reality, insurers are not going to want to have unlimited options that they're insuring. So that might be something that needs to be addressed and dealt with prior to going to market, or at least there being a good plan to sort it out. And then the last thing I'm going to mention is there's always a flow of unwelcome case law in pensions. We've had a couple over the summer, one related to Section 37, the NTL case. That is going to appeal, but has created a lot of uncertainty as to what to do, what trustees should positively be doing. whether they've got a problem in terms of whether previous benefit changes have been made correctly. So that has kind of thrown a lot of questions in. Thankfully hasn't stalled the market, which I think was the initial concern. So it's very much a watch and wait, but it is something where if schemes are going to buy out, you can't just ignore. You need to actually think about and make a decision. So that's been very relevant and will no doubt be top of the list of pensions chatter over the next year. Another unwelcome for schemes, possibly welcome for members, case law that has come out is a BBC case in respect of a restriction on the power of amendment. And in that case, it suggested that amendments couldn't be made to stop future accrual. So, not necessarily directly related to buyout, but if schemes think they're closed and had that kind of amendment power, they are the schemes trustees should be looking, I would say, to see whether that amendment power relates to their scheme and whether there's any issues in terms of the closure. So these are all the things coming out. So the start of the talk was all about kind of insurance and structuring and things, but these are very much kind of, in some ways, proper pensions law and things that should be thought about before approaching market, because actually insurers don't want trustees saying, oh, we're ready to trade, and then raising a whole host of problems towards the end. So I think that is enough from me, having chatted for far too long. And I shall hand over to Rianne to give you the insurer perspective.
Thanks, Sarah, for the introduction and very interesting presentation. As Joanne said at the start, I'm a Senior Business Development Manager at Standard Life, and I look after everything that's related to the pricing, structuring and execution of new business. And one of the most interesting parts of my job is the varied and complex challenges that schemes are facing when they come to market, and thinking about how we as insurers can help them get through that. So we wanted to spend some time in this session talking through some of those points. So here's a non-exhaustive list of some of the issues that we're seeing schemes facing at the moment. Most of these are things that Sarah has mentioned. And so what I wanted to do is spend a little bit of time talking about our perspective on these issues, how we might think about solutions to them. As Sarah said, it feels quite odd to talk about surplus as a problem. It's certainly a very nice problem to have. And I can certainly think of majority of my career spent in consulting when schemes would have been absolutely delighted to have to think about surplus. The world's really changed, and there's a lot of different things for trustees to think about these days. Now, this isn't an exhaustive list, and there are other issues and other complexities that certain schemes bring. So, for example, things like existing longevity swaps that need to be novated as part of a buyout, schemes which are part of the LGPS or other sort of quasi-public sector organisations which might have particular challenges as well. So we'll start with everyone's favourite subject, illiquid assets. So going back to why this is such a feature these days, I think a lot of it can be linked back to around about 12 months ago, when the mini budget led to a massive increase in interest rates. What that meant is that schemes who had perhaps thought they were 5 to 10 years away from being fully funded were suddenly technically able to secure the benefits in full. However, an awful lot of schemes in that position were still holding some form of illiquid assets, whether that's pooled property funds, private equity, private credit, all different shapes and sizes we've seen. And actually this has become a consideration for schemes of all sizes, even right down to sub 100 million schemes we're seeing come to market still holding some illiquid assets. So how do we deal with that? Well, a lot of the time we get asked the question, will you take on these assets? It's not unheard of for insurers to take on illiquid assets, so it's certainly a question worth asking. But I really think that trustees should be asking a slightly different question. I think they should be asking, what value can I get for these assets from an insurer, and how does that compare to the value that I might get elsewhere? Because trustees need to weigh up the value that they might get from a quick single counterparty solution where everything's done in one go, only dealing with one other party, versus the potential economic loss that they might see by doing that. Insurers are not necessarily the natural owner of a lot of the illiquid assets that pension schemes hold. That's because pension schemes and insurers have different regulatory regimes. So assets that make total sense in a pension scheme environment are not necessarily treated very well on the insurer's balance sheet. And that might mean that actually the economic value that we see in them isn't quite as good. There might well be better solutions found by going to the secondary market and finding a buyer elsewhere. Deferred premiums is really part of that solution. So a deferred premium means that the whole of the premium isn't due on day one or within a few days of signing the transaction. There might be a period of time, whether that's 6 months, a year, 2 years, for the scheme to pay the final part of the premium. And that's often linked to the idea that the illiquid assets will be sold in the secondary market in that time frame, or perhaps in some cases it's to allow time to run off naturally if they're very close to the end of their lives. Now, deferred premiums, again, is something that trustees do need to think quite hard about. They need to think about what's the consequence of being unable to pay this premium in future. So what would happen if I couldn't get the money for my illiquid asset sale that I thought I was going to, and actually it's short of the amount that I owe to the insurer? You're then in an environment where you've only insured 95% of the scheme. You don't really have any assets left to sweat to make up that difference. It's quite an uncomfortable position. It's certainly something that employers should be completely bought into if trustees are going down that route. But that said, we've seen lots and lots of cases where deferred premium has been a really sensible solution and has made sense for the client, and we're pleased to be able to support clients in doing that. Now, there's some other more complex solutions which are perhaps really mainly applicable for the very large schemes. Thinking about things like obtaining financing from a third party, or restructuring the assets to make them more friendly to an insurer's balance sheet and avoid some of those frictional issues with different regulatory regimes. Those can be really beneficial, but it's a lot of investment, very complex. You need a trustee and an employer who's got real appetite to do some serious work in order to resolve these issues. Finally, it is also worth thinking about, well, actually, do we want to insure the whole scheme right now? Maybe we don't. Maybe we take out a section and insure most of it with a view to completing the rest of the transaction later. Maybe our insurer will agree to work with us to do a follow-on transaction shortly afterwards. Every insurer I can think of would be really pleased to work with a client in that way. So there's lots of different options. What I'd really encourage schemes and advisors to do is to talk to the insurers, engage, think about the real specifics of the case in question rather than trying to apply blanket rules. And there are lots of solutions which can get to schemes where they need to be. So then moving on to existing buy-ins. So a little while ago, it was very common for schemes to be insuring part of the scheme. So to say a pensioner only, either all their pensioners or part of their pensioners. And that was an investment decision, a de-risking decision. Now many schemes are better funded, coming to the end of their life as a scheme, as it were, and looking to secure the rest of the scheme. And trustees are faced with a question about whether they stick with their existing insurer, so they've just got one counterparty across the whole scheme, or insure with someone else. Both of them are perfectly valid options, and trustees should take advice on that. But a few things worth thinking about. So one that I'd really call out would be consistency of member experience. So particularly if you've got deferred members secured with different insurers, are all the members going to be benefiting from the same terms for member options, transfer values, cash commutation? Will all members have at least an adequate level of service and care that trustees are happy with, and ideally as consistent as possible? One thing that I would really recommend if you're coming to market with an existing buy-in with another insurer, we find it really useful to hear from the client, these are the things that we have covered on our existing buy-in that we really care about and we want to make sure are consistent. That means that we've got that immediate visibility of what is it that's important, and we can think about, is that something we can do? And there's no debate down the line. Having existing buy-ins can be really helpful because it means you've got a relationship with an insurer who might be able to support you with price monitoring, might be able to help you think about how you can shape your investment strategy to get yourself in the best possible position. Sarah spoke a lot about residual risks and wraparound cover, so I won't spend too much time on that right now. But just to say, I'd agree with Sarah's comments here that wraparound cover is fairly new. It's been done a few times. There's starting to become some precedents for how it can be done, but again, it takes thought, it takes engagement, it needs good cooperation from everyone involved. Surplus. So is surplus really a nice problem to have? Well, I think it is, because ultimately the job of a trustee is to secure the benefits. And if they've done that and they've got money left over, then great. I guess what you don't want, though, is to have a surplus to use and to spend so much time and money thinking about how you deal with that surplus that you're not really adding any value to members through it. We've talked about residual risk cover, and we'll come back to that in some more detail in a moment. Benefit augmentations are obviously, from a member's perspective, fantastic, getting even more than they were strictly entitled to. I think again, thinking about our perspective on where we've been asked to look at enhancing benefits insured, trustees should think about and talk to insurers about how to do this in a way that adds real value to the members and isn't just going to turn into significant risk premiums being paid to insurers. Not only does that usually come with something that's quite hard to administer, but it's not really adding that value into members' pockets. So often the simplest solutions are best when it comes to benefit augmentations. There's some interesting consultations going on at the moment and discussions around making it easier for surplus to be returned to sponsors outside of a buyout and wind-up situation. And it's a really interesting topic, and it'll be interesting to see where the consultation goes. I think it's really challenging in practice, and trustees need to obviously think very carefully about the strength of their sponsor if they are looking to return surplus funds ahead of a buyout. Post-buyout, obviously fewer challenges in that sense, and it'll, as Sarah said, it comes down to what do the scheme rules say, who's got the power, but difficult judgments for trustees and sponsors to make. So just to touch on some of the challenges for the very largest DB schemes out there, and again, as Sarah's covered many of the legal angles, just talk a little bit more about the insurer side and some of the things that we think about. Now, very large schemes, everyone thinks that big is always better, but that does have to be weighed up against the very, very significant capital requirements involved in taking on multi-billion-pound schemes. In addition to that, insurers need to be thinking really hard about how they can trade up into their asset strategy at real scale as quickly as possible. Really, for these very large DB schemes, the solutions are going to be entirely bespoke. There is nothing off the shelf whatsoever about something in the multi-billion size. And trustees, advisors, employers should all be looking to engage very, very early with insurers to discuss their circumstances, think about what might be possible. The other thing to note on this is that actually there is probably an impact on normal, so-called normal size schemes. If there's a few of these multi-billion-pound mega schemes in the market at once, and insurers are looking to perhaps, take down multi-billions of liabilities in one go, then how is that going to impact on capacity for other transactions at the same time, whether that's from a people resource perspective or from a capital perspective? It's going to add some really interesting dynamics, particularly where these trades are happening towards the end of a financial year. So talking about residual risks, so with residual risks, there's a lot of different processes that we see being followed. Most schemes, in my experience, prefer to take out residual risks at the point of buy-in. That has a lot of advantages. It does add some time pressure, though, to the process. So if that's something that trustees want to do, they really need to be preparing themselves well in advance and making sure that their lawyers are helping them get themselves set up to make that work. Now, we see a lot of schemes coming to market with either a vendor's report, so a legal advice report that's been prepared on behalf of the trustee, but can be shared with insurers, or a buyer's report where the report is actually prepared on behalf of the insurers, usually with the successful insurer paying the eventual costs for that. I think both of those are really good because what they allow is early sight of any issues. So the worst case scenario with residual risks is you go through 6-8 weeks of due diligence, people working very, very hard, coming right up to the point where you're about to trade, and then an issue comes up that no one spotted before, and actually no one really quite knows what to do with it. Can we proceed? Are the trustees happy to retain the risk? Can the insurer get comfortable taking the risk? And obviously the worst case scenario is that the whole transaction falls over as a result, which is in no one's interest, and potentially a disproportionate reaction for something that might, in the scheme of things, not be the biggest risk that the trustees are facing. So having early sight gives everyone time to think about how can we deal with this? What do we need to do? Can we find any more information to help us get comfortable? Now, transitioning to buyout, so there's been a bit of talk about capacity in the market and the constraints that we're seeing. And Zara rightly pointed out a lot of the constraints are not necessarily on the insurer side, but on the scheme administrator advisor side, where there is a real burden on people and a real constraint with people to get everything done. And that doesn't stop at the point of transaction. So taking the scheme from the point of a buy-in transaction all the way through to buyout is a really time-consuming and resource-intensive process, particularly for schemes where there's quite a lot of data work still to be done. Some schemes come to market and are really clear that they want to transition to buyout very quickly. And by very quickly, that might mean anything from within the same calendar quarter to inside of a year, which might not sound very ambitious, but for some schemes that really is ambitious. There's lots of things that can be done in advance of a buy-in to make that transition as quick as possible. So communication, again, really important. Trustees should be talking to the insurers, making sure their expectations, their needs are clear, understanding what the timeline might look like, making sure that everyone really does understand everything that needs to be done in that period and how it can work most efficiently, what can be done at the same time in parallel to speed things up. Goes without saying, really, that getting data in shape before a buy-in transaction is absolutely critical to ensuring a quick transition through to buyout. If the data's in very poor shape, it's really going to be extremely challenging. Thinking about member communications is also really important here. So as the insurer who will eventually be looking after the members as policyholders, we really want to make sure that that journey for members is a positive one, is clear, it's communicated really well, so that they don't feel like something's happened without them really having any understanding of what's going on. They don't feel like it's a negative for them. That concludes my presentation, so I'll hand back over to Joanne to take questions.
Great, thanks very much both. So we're at 1:45, so we've probably got 5 to 10 minutes for questions, and we've had a few come through. And just turning to the first kind of theme, which is really capacity in the market. So I guess, Sarah, one of the things you mentioned was, you know, the change in what's regarded as perhaps a small scheme and a large scheme. And I guess, Rhian, you might have thoughts on this as well. But when you say a large scheme, what do you actually mean by that in terms of size? That's one of the questions that's come through.
I think not long ago we thought anything over £500 million was a large scheme. Now I think large is anything over £1 billion.
Okay.
And I think, yeah, small is probably up to a couple of £100 million now, whereas we would have thought it more around the 50 million mark before.
Yeah, that's helpful. Rhian, I don't know if that kind of chimes with how I appreciate each scheme's different and each transaction's different, but how you kind of view things from an insurer's perspective.
Yeah, I would broadly agree with that categorization. I mean, it's obviously every insurer will see things a bit differently. I guess I would also say, if it's helpful, that we wouldn't really see any hard and fast rules, you know, sub 200, we won't do this, over £1 billion, we won't. Every transaction is looked at on its own merits and considered case by case.
Okay, and I guess linked to the last point you've made, another question's come through, which is, how do you decide as an insurer which schemes to quote on and how competitively to quote on a given scheme, particularly with the capacity crunch that I think we're all seeing in the market at the moment?
Yeah, so we have a sort of weekly triage process where we look at all the opportunities which have come through, and look at our resource planning and figure out what we can quote on. So every insurer will be different here, so I'm just speaking for Standard Life.
Yeah.
But we're really looking for things like transaction certainty, and actually I probably can speak for everyone when I say that that's a key criteria. You know, are we confident this transaction is going to proceed? It's very rare, to be honest, now that the answer is no. Most schemes come to market very well prepared and with that certainty. We're looking at things like what's the resource requirement for this scheme, and how does that weigh up against the size and the opportunity? So a scheme that is both small and very, very complex, or perhaps the data is not in very good shape and needs a lot of work, that's going to be harder to justify deploying our resource there. In terms of competitiveness, so I would say if we decide to quote on a transaction, we always put our best foot forward. But in particular, where we've got, you know, really good relationships with the client already that we want to maintain, perhaps they're an existing client of ours, that'll be situations where we would really put our best foot forward.
Okay, no, that's really helpful. Thank you. And one question which relates to one of the cases that Sarah mentioned, so the NTL Virgin Media case, and I guess you both have views on this. So the question is, does the NTL Virgin Media case change your approach to residual risk? So it'd be interesting to hear about that, you know, Sarah, from your perspective, but also Rhian from yours as well, if you've got any thoughts.
I suspect I know what the insurer answer is. In terms of the trustee answer, or looking at it from a trustee perspective, I think it's important that the trustees think carefully and liaise with their sponsor on this point, because I would say most insurers are going to exclude execution risk, and if you do open up execution as something that you want covered to the extent an insurer will cover it in principle. That means they're going to crawl all over everything and take a very conservative view. So I think it's more an issue for trustees and what they're comfortable doing. And so it becomes a discussion with the employer. So is the employer going to sit behind that risk? Do they want any kind of quantification of that risk? You know, because if you're looking at buyout and all the assets have gone, if they're going to give an indemnity, they want to know what that might be for. So we have had some kind of trustees and corporates want to have a peek to see whether there is a kind of real risk or not. But it's quite tricky at the moment because obviously we're waiting for an appeal. So there's no one right answer to this, and it depends on the scheme and whether we think it's a kind of theoretical risk or whether there's a kind of real risk and the trustees know whether there's an issue or not.
Okay.
Yeah, I agree with that. I think from an insurer perspective, to cover the risk on something, as Sarah said, you've got to go and do your due diligence. So if we were normally, execution risk is something that's excluded as standard simply because it is so difficult to due diligence. Quite often we're talking about looking for a certificate written by the actuary upwards of 30 years ago. It's going to be really, really hard to find. We see, as well as the appeal, we're expecting that there'll be some lobbying, I think, of DWP to put in, if the appeal fails, then helpful legislation to make sure that we're not looking at creating excess work, excess liability for no real value for anyone.
No, thanks both. So just turning to the issue of surplus, we've just had a question come through, which Rhian, I guess it's perhaps one for you initially. So when surplus is being used to augment benefits, what typically works best for insurers in terms of how benefits are augmented? So the shape of those benefits, so additional pension, higher increases, etc. I don't know if you have a view on that at the moment.
Yeah, so I mean, a sort of, I guess the most simple option is a straight percentage uplift across the board. And that means that all the cash flows from our perspective are exactly the same, just uplifted a little. Things like higher pension increases, well, that works absolutely fine. But I think trustees just need to bear in mind that if they come back after having already got pricing and say we want to change the pension increases, then that might change our investment strategy. So it's not quite as simple as just applying a percentage uplift to the benefits. We've seen more complex requests as well, like enhanced factors, enhanced death and service benefits. Again, all things which are possible, but just need to understand the implications and what that might do.
Okay, thank you. Okay, so I think we've got time for a couple more questions, just thinking about smaller schemes. So I guess a couple. So requested contract terms, Sarah. So the question is that this individual's been told that on small trades, schemes get the terms they're given, so small schemes. Is there any room for negotiation in your experience on those?
My view is yes. I mean, if you don't ask, you're not going to get. There might be good reasons why the insurers want to trade. They might have set aside capital and that their trade falls over. So I think it'd be daft to assume, oh, these are the standard terms, I've got to get them. But I think there does need to be a bit of reality as to what you're asking for if you're a small scheme. So that's when advice from brokers and lawyers is useful as to what is practical and where you're being a bit fanciful. But no, I think, unless you're going down a kind of pre-negotiated route, if you've got standard terms, you should ask, but be mindful of what an insurer will give you if you're a small scheme.
Okay, thank you. And then I guess a final question for you, Rhian. So we were talking about how busy the market is at the moment. And I think you alluded to the fact that being prepared is absolutely critical when you get asked to quote for a trade. So the question we've got is, because the market's so busy, will my small scheme even get a quote?
So far, I am not aware of any schemes who've come to market who have failed to get any quotes at all. And I'm saying that from my own perspective, having spoken to all the other insurers and EBCs and lawyers, no one can really identify cases where schemes are not getting quotes. So I think that's fantastic. I think it shows the market's really functioning very well. I think for schemes which are under, say, 100 million in size, we're certainly seeing quite frequently that there might only be 1 or 2 quotes being provided. I don't think that only 1 quote being available is necessarily a bad thing. I think in that situation, trustees just need to make sure that their advisors are giving them strong advice on what represents good value. And that might be different from scheme to scheme. So, you know, schemes, if your priority is just securing the benefits, then it's good value if it's affordable in one sense. But equally, the brokers know what normal pricing looks like. They can challenge an insurer if the price isn't good. And trustees, I think, should be able to put some confidence in that process.
Okay, that's brilliant. Well, thanks very much, both of you. I think it's been a really interesting and useful session. Given the time, we're now going to draw to a close. But before I do so, I'd just like to mention the second in our series of scheme sessions, which will take place at the same time next week, so 28th of September. And in that one, we've got 2 of our pensions dispute specialists, Aaron Denning-Foreman and Charlotte Scholes, who are looking at issues that can arise on schemes and as you prepare for risk transfer, and look at commercial and pragmatic ways for dealing with those issues so as to sort of not impact on the actual risk transfer timeline. Also, if you've got 2 minutes, we'd be really grateful if you could answer the feedback questions, please, that will pop up on your screens shortly. And it just remains to be said, thanks very much to our speakers, and thanks all for attending. Hope to see you soon. Thank you.